Did you know that China has slashed its U.S. oil imports by a staggering 90%? In a dramatic shift, Chinese refiners are now importing record amounts of Canadian crude, marking a significant realignment in global energy trade. In 2025, the United States reignited its trade war with China by imposing a 10% baseline tariff on all Chinese imports, citing national security concerns related to synthetic opioid trafficking. This move, formalized through Executive Order 14195, added to existing tariffs from previous years. China swiftly retaliated with tariffs of up to 15% on U.S. energy exports, including crude oil and liquefied natural gas, and 10% on other goods like agricultural machinery. These tit-for-tat measures have disrupted traditional energy trade routes. China, the world's largest oil importer, has significantly reduced its reliance on U.S. oil, slashing imports by approximately 90%. This shift is not merely a tactical response, but signifies a strategic realignment in China's energy procurement strategy. Canada has emerged as a key beneficiary of this realignment, with its vast oil reserves and recent infrastructure developments, such as the expansion of pipelines in Western Canada. Canada is well-positioned to meet China's growing energy demands. This burgeoning energy partnership between China and Canada underscores the broader implications of the U.S.-China trade war, highlighting how geopolitical tensions can reshape global trade relationships. The implications of this shift are profound. For the United States, the loss of a major energy export market could have economic repercussions, particularly for its oil and gas industry. For China, diversifying its energy sources enhances its energy security and reduces vulnerability to geopolitical tensions. For Canada, increased exports to China could bolster its economy and elevate its status in the global energy market. As the trade war continues to evolve, the global energy landscape is being reshaped in unforeseen ways. The realignment of energy trade routes underscores the interconnectedness of global markets and the far-reaching consequences of geopolitical conflicts. China's pursuit of energy security has become increasingly complex amid escalating trade tensions with the United States. The imposition of significant tariffs by both nations has disrupted traditional energy trade routes, compelling China to reassess its energy procurement strategies. In response to U.S. tariffs, China imposed its own set of tariffs on American energy products, including a 10% tariff on crude oil and a 15% tariff on liquefied natural gas. These measures have not only increased the cost of U.S. energy imports, but have also introduced significant uncertainty into China's energy supply chain. The volatility in global oil prices, exacerbated by the trade war, has further complicated China's energy strategy. The International Energy Agency has downgraded its forecast for global oil demand growth in 2025, citing the economic risks posed by the U.S.-China trade tensions. This slowdown in demand growth adds another layer of complexity to China's efforts to secure stable and affordable energy supplies. In response to these challenges, China has been compelled to diversify its energy sources, seeking alternative suppliers to mitigate the risks associated with over-reliance on any single country. This strategic pivot is not only about securing energy supplies, but also about asserting greater control over its energy future in an increasingly uncertain global landscape. The shift in China's energy procurement strategy has broader implications for global energy markets. As China reduces its reliance on U.S. energy imports, it is forging new partnerships with other energy-producing nations, thereby reshaping global energy trade patterns. This realignment underscores the interconnectedness of global markets and the far-reaching consequences of geopolitical conflicts on energy security. In response to escalating trade tensions with the United States, China has strategically shifted its energy procurement strategy, significantly increasing imports of Canadian crude oil. This realignment is not only a reaction to U.S. tariffs, but also a calculated move to diversify energy sources and enhance energy security. Recent data indicates that Chinese refiners imported a record 7.3 million barrels of Canadian crude in March 2025, a substantial increase from previous months. This surge is facilitated by the completion of Canada's Trans Mountain Pipeline Expansion, TMX, in May 2024, which added 590,000 barrels per day of export capacity, providing Alberta's oil sands with direct access to Asian markets. Canadian heavy crude, particularly Western Canadian Select, WCS, offers specific advantages for Chinese refineries. Its high sulfur content aligns well with the configurations of modern Chinese refineries, and it is relatively cost-effective compared to similar grades from other countries. This compatibility not only ensures efficient processing, but also provides a cost advantage, making Canadian crude an attractive option for China. Furthermore, Chinese energy companies are solidifying this partnership through long-term agreements. For instance, PetroChina entered into a 10-year offtake contract with Canadian Natural Resources Limited, CNRL, for 100,000 barrels per day, which commenced in July 2024. Such agreements underscore the commitment of both nations to a stable and mutually beneficial energy trade relationship. This strategic pivot not only mitigates the risks associated with over-reliance on U.S. energy imports, but also positions Canada as a key player in China's energy landscape. As geopolitical dynamics continue to evolve, such partnerships highlight the importance of adaptability and diversification in global energy strategies. China's strategic pivot in energy procurement reached a defining moment in March 2025 when it imported a record 7.3 million barrels of Canadian crude oil, surpassing imports from traditional suppliers like Saudi Arabia. This significant shift is a direct response to escalating trade tensions with the United States, which led to a drastic 90% reduction in U.S. oil imports by China. The completion of Canada's Trans Mountain Pipeline Expansion, TMX, in late 2023 played a crucial role in facilitating this transition, providing Alberta's oil sands with direct access to Asian markets. The TMX expansion added 590,000 barrels per day of export capacity, enabling Canadian crude to reach China's refineries more efficiently. This development not only offered China a stable and cost-effective energy source, but also allowed it to mitigate risks associated with geopolitical tensions and over-reliance on a single supplier. The compatibility of Canadian heavy crude, particularly Western Canadian Select, WCS, with China's refining capabilities further solidified this partnership. For Canada, this surge in exports to China represents a significant opportunity to expand its presence in the global energy market. The increased demand from China could bolster Canada's economy and enhance its geopolitical influence. This realignment also has implications for the United States, as it faces challenges in finding alternative markets for its energy exports, potentially impacting its oil and gas industry. This pivotal moment underscores the dynamic nature of global energy alliances and highlights the importance of adaptability in energy procurement strategies. As countries navigate complex geopolitical landscapes, strategic partnerships like the one between China and Canada become increasingly vital in ensuring energy security and economic stability. China's strategic pivot from U.S. to Canadian oil imports amid the ongoing trade war represents a significant shift in global energy dynamics. This move underscores China's commitment to diversifying its energy sources and reducing its dependence on any single supplier. For Canada, this partnership offers an opportunity to enhance its role in the global energy market. The increased exports to China could bolster Canada's economy and strengthen its geopolitical influence. Conversely, the United States may face challenges as it seeks alternative markets for its energy exports. The reduction in Chinese imports of U.S. oil could have economic implications and influence the dynamics of global energy trade. This realignment also highlights the broader impact of geopolitical tensions on global trade relationships. As countries navigate the complexities of international trade, strategic partnerships and diversification become increasingly important. China's shift towards Canadian oil imports amid the trade war with the United States is a testament to the evolving nature of global energy alliances. This development not only reshapes energy trade patterns, but also underscores the importance of strategic partnerships in navigating the complexities of international trade. What are your thoughts on China's strategic shift in energy imports? Do you believe this will lead to lasting changes in global trade dynamics? Share your insights in the comments below, and don't forget to watch our next video exploring the broader implications of these trade developments.